So yeah, they're a little hotter. And by the way, a lot of what Steve said is right. We are going to follow going forward. There are so many cross currents around trade, the dollar. How does that going to play through over the coming weeks and months? It's going to be incredibly important. Listen, inflation is trending higher, full stop. We're going to see it in CPI. PPI, this is interesting when you talk about the tariffs being put on now. One of the things the president's trying to do is avoid what affects the consumer. But you can get that into input costs. It's part of why these numbers, PPI going forward, which the markets tend not to follow as much as CPI, will get a lot more focus.
In terms of the core number as well, I mean, where you're noting food and the potential impact of trade, is the overall number impacted, in the core number impacted, in that could we see rising commodity costs on the steel and the metal side impacting the manufacturing? So we're seeing it on both sides.
Yeah, you would see it that way. But look, certainly you could imagine a kind of J curve on this stuff where prices would fall initially because let's say I'm sending stuff abroad and I can't send it abroad anymore. I've got to sell it domestically. That could initially create a glut. Right. And then what you'd have is you'd have production rationalized and then prices would rationalize along that way. One thing we've seen in the past is when you have tariffs on imported goods, American producers or the domestic producers, such as they are, would not necessarily lower cost below that. They would raise cost up to it. So there could be, as Joe has suggested, an inflationary impulse in this. But Rick, I just want to ask you a question here. Looking at, you were talking about the 10-year yield being at a place where it's kind of cool, especially even on the short end, you're making some money there. But let's look at it the way economists think you're supposed to look at it, which is on an inflation-adjusted basis. You're still making less than 1%. If you look at the real 10-year yield, it's below 1%. It's been below 1%. We know that the Fed, and especially Powell, likes this number as a sign of, what does the market think about what the neutral rate is? So when you see that, first of all, is that enough for you to say there's real money there? If I'm getting, what is that number? It's below 0.8% on the real yield of the 10-year. So that's not a lot of money from that standpoint. And what is the message of the market to the Fed about where neutral is if that's the 10-year yield?
So I think, first of all, it's a long, long discussion about different parts of the yield.
You have 30 seconds. Just
that's perfect. Yeah, listen, there are a couple of things. That when you think about what the real rate is, what that term premium is, it's not price straight. The market today was telling you what they think the terminal rate is. The Fed is not going to ultimately go. I mean, the consensus economist view will go 4 times this year, 4 times next year. Market's dubious as to how much. We've got an economy now that's operating incredibly well.
Let's just do the addition for people, because 4 and 4, where would we be? Well, I think it's 3 next year, but that's a semantic difference here. Where would we be on the Fed funds at the end of next year? We would be well above where the 10-year yield is right now, right? Or at the 10-year yield.
Correct. And by the way, you've got a dynamic. We think the neutral rate, when you get to equilibrium, we think it's closer to 2.5, 2 3/4. You're going to get to a level that is going to put pressure potentially on the economy. By the way, we don't think it'll need to go that far. We think the economy's surging today and is going to be really strong. You're pulling forward tremendous amounts of growth. It'll be interesting to see next year in terms of where we go. You got wages accelerating, you have interest expense accelerating, and you're pulling forward so much CapEx. I wonder how much further the Fed is going to have to go and whether they're going to get into the mid-3s, as many have said they're going to do.
So 2.5 next year is your number? You think where they stop?
So listen, I think you got to give it to 2 3/4, but I don't think they're going much further. And the front end of the yield curve, the reason why people are making money in the front end today, I mean, look about the aggregate index.
No risk and lots of,
It carries extremely well. It doesn't create a lot of risk. And what's going to happen is if rates move higher, the curve could flatten, but you're going to get killed in terms of price performance in the long end of the yield curve. And what happens if growth slows, the front end is going to start to move because the Fed's going to stop. So it's very directional around the shape of the yield curve, which people don't talk about.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.